Thank you so much for joining us today. Eric Cramer, our Chief Investment Officer, I'll let you take it away from here. Thank you, sir.
Thank you, Bill. And I'm pretty excited to be able to deliver a lot of good news in this quarterly market report. I've certainly become aware that the financial media has been talking quite a bit about, the recovery and the potential recession. And I'm not sure what we're recovering from at this point. The markets have been doing great. The economy's actually been doing real well. So we're gonna spread some good news today. There's going to be 4 parts to the presentation. We're going to kick things off with a quick economic summary, and the headline here is "The transition has begun." So why don't we just go ahead and jump into that? And I probably should have said the transitions have begun, but to take a quick step back and remind you of the past, we spent about 2 years telling you that we weren't going to have a recession, that the economy actually looked pretty good. And please don't lose your faith in the stock market. Another way of saying that is we were violating the conventional wisdom that says don't fight the Fed, because normally when the Federal Reserve is raising interest rates, you want to be pretty careful, because there's certainly an intent there to lower economic growth and maybe cause a lot of other effects from their rising interest rate policy that can be very difficult for investors. And we came back and said, don't worry about that. There's some other parts of the economy that tell us this would be a time to fight the Fed. Well, now the transition has begun, and we're about to switch back to don't fight the Fed. We actually think interest rates may begin to come down, but let's jump into some of these transitions. And the first is in the employment market. We've talked for so many quarters about how strong the employment market is, and the data at this point would still lead you to believe that. In fact, it's a bit too strong. If you look at the blue line here, that is the headline unemployment rate, and we can see that it's very, very low. The spike during the pandemic was one of the most pronounced and sudden spikes we've ever seen, but the employment market found its strength pretty quickly after that. You'll notice from the graph that it is below this green line and this red line that are telling you the theoretical minimum unemployment rate, and we're below the theoretical minimum. So we're past full employment, something that isn't really supposed to be able to happen. And even though you might see the 3.6% rate out there, if we're talking about what you might call the backbone of the information economy, the educated professionals, the folks 25 and older that have a 4-year college degree or more, that unemployment rate keeps slipping below 2%. So there's just no more workers left out there. It's been holding back the economy, but now this transition has begun, and I think we're gonna hear in the coming months what might even sound like bad news. Certainly that'll be the first headline that you read, something along the lines of disappointing employment report. But that's really what we need to happen, where we're overemployed. And part of the reason that is happening is because of the fantastic developments that are happening with artificial intelligence that are going to bring scale and increased productivity and a higher level of efficiency to really every sector of the economy. So it's the relief we need just in time, because this lack of workers is impeding our economic growth. But we're about to get a little bit of relief from what some are calling the next industrial revolution. That's the advent of AI. Part of the depth of the story that you might want to understand about the employment market, and anybody that is running a firm and trying to hire educated professionals in particular will understand this, is that there's almost nobody left to hire. And there's 2 lines on this page. I'll just mention the blue one. That's actually not the one that's too important. The blue line is the participation rate. That's everybody that in theory could be in the workforce. And how many of them are there? What's the percent that are of that maximum potential? So if you're not incarcerated, if you're not in the military, if you're not a farmer, exclude a few groups there, how many are participating, but that's age 16 and over. So I'm not sure how important it is to roll into the numbers high school kids, 17-year-olds. I'm not sure how important it is to roll in, long retired 80-year-olds and folks like that and say, well, how many of them are working? I think it's far more important to look at the red line and say, well, what if you're in that prime working age? What if you're age 25 to 54? That participation rate, 83.5%, is at a 2-decade high. So if at some point the narrative was people just don't want to work, that's not the right narrative anymore. We've got more people working than we thought we could see. This number, this participation rate, is supposed to be declining due to demographics, and it's actually been increasing. So we're at a level now for that red line in particular that's substantially higher than it was pre-pandemic, and really about the best we've seen in a couple decades. I don't think it's sustainable. The economy's been good. The stock market's been good. There's a lot of people that are older that are going to be making some choices there, and I think that participation rate is actually going to fall. So again, we're kind of counting on artificial intelligence to give us some relief with workforce pressures. And if you were to go read any of the quarterly corporate reports for publicly held companies, I'd challenge you to find one that isn't talking about AI and how it's already changing their business. One last bit about employment. This has just been so important. In fact, the strong employment numbers were one of the reasons we said that you could fight the Fed. They weren't going to be able to beat back this strong economy. Is this measure of productivity. And this is another big transition that's about to occur. We've been watching productivity fall, and that's always a bit concerning. In the past, one of the healthy outcomes of a recession was that companies had to rationalize their workforce. They had to become a little bit more lean, figure out how to do more with less, figure out what they could automate and so on. Well, as you've heard me say already, we don't think that we're going to have a recession. We've been saying that for a couple of years now. So what is it that's going to cause a transition here? Well, again, the story is all about artificial intelligence. I think a lot of folks running businesses who were eager for more employees to be able to grow may have found themselves hiring some folks that were really not great fits, just throwing bodies at the problem, if you will. And so as you hire that marginal worker, your productivity goes down because you just don't have the people that you need for these positions. And folks running businesses have been lamenting this for years, but it's gotten especially bad as the labor market has tightened. Well, now productivity has fallen, and strategic leaders at firms are taking a step back and going, we got to figure something out here. And again, this is an artificial intelligence story. And in fact, as we see scale and efficiency being dramatically increased all across the economy with these new tools, we expect to see productivity begin to take off. And that's great. This kind of expansion in economic output per worker is exactly what every investor is hoping to see. So if you're an investor in the stock market, this is a great way to see economies expand even when the workforce is limited. And so, one of my favorite examples from about 6 months ago was when an audience member talked about how their real estate firm was using AI to analyze real estate contracts that were hundreds and hundreds of pages long. And you can imagine what it might take to do a thorough legal review of long contracts. And we're not saying abandon the lawyers yet, but you can send a 300-page contract through ChatGPT and ask it to look for vulnerabilities and potential legal defects and things that could happen that could hurt one position in the contract, one party to the contract versus another, and get some really interesting results. So you can do reviews and get scales of around that type of process where your output might take a couple of minutes instead of weeks. For the normal legal review. So, and that's just one example. I could sit here and go through hundreds. So expect that productivity number to jump. but without us all having to endure a recession to get there. Inflation is one of the main foci of the Federal Reserve, and they've been talking about the inflation problem. And I would contend that capitalism has a way of taking care of inflation, even if the Fed is going to want to take credit for dealing with it on their own. One element of that we've seen is wage growth, and wages are still growing, but the rate of wage growth is now declining. I think a lot of companies have become quite frustrated with what's been required in the labor market to hire people, even when the productivity was not there. And so you're now seeing this rate of wage growth come back. And again, capitalism has a way of sort of weeding out the weak and figuring out how to deal with this kind of thing. I think it's worth mentioning too that many companies have figured out that they ought to listen to their employees a little bit. And, you know, sometimes an employee will value worker flexibility. Sometimes they can work from home, they can do other things like that. And, you know, the right combination of that and wage increases might be more valuable than just a wage increase. And so we're seeing a tremendous uptick in the flexibility of employers to accommodate these types of situations. We think that's probably a permanent change. And in so doing, it takes a little bit of the pressure off of wage increases. And of course, wage increases are a big component into overall inflation increases. And so if we look at overall inflation, what we'll see on the next slide is that inflation increases are coming down as well. So we still have inflation, it's still embedded across the economy in a way that probably means the Fed is not going to see its 2% target anytime soon. We're seeing numbers move into the threes, and we said a quarter ago, before any inflation measures were in the threes, expect to start seeing inflation numbers that start with the digit 3, and sure enough, that's what's happened. So this is personal consumption expenditures. Here, that's the Fed's favorite measure of inflation, but even the headline CPI numbers that you heard about, have heard about for years and would have heard about last month, are now starting with a 3. So I don't know that we're going to get below 3, but I think we'll continue this gradual march closer and closer to the Fed's target of 2. So again, you know, there's a saying about capitalism: nothing cures inflation better than a little bit of inflation, because smart, strategically oriented competitors in a capitalist economy will figure out how to outcompete companies that can't deal with inflation and rising supplier costs and commodity costs and things like that. And you know, everybody's got examples of this that I'm talking to lately about how they're starting to find bargains again. I know Ford just lowered the price of its electric F-150 by $10,000. I just got some new reading glasses, and you know, Amazon was selling a 6-pack for $13, and it allowed me to take my new prescription that's a different prescription for each eye, and buy 6 of one prescription and 6 of another prescription and pop out half the lenses. And, you know, for a modest price, I've got 6 reading glasses instead of going to an optometrist and spending $150 or $200. And, you know, I love them. I've got all the different colors now. But pick any industry and the deals are coming back. Corporations are figuring out how to deliver those deals. So again, this is a theme you keep hearing: capitalism. Businesses are finding a way to come in and compete, and that's most of what's bringing inflation down, with a little bit of assist from, yet again, falling commodity prices. So beef got a little bit more expensive, soybean oil and sugar got a little bit more expensive, but most all of the inputs into industrial processes, including the industrial metals there at the bottom, aluminum, nickel, and zinc, with dramatic falls, means that suppliers are, in the next 3 months, in the next 6 months, because this takes a while to work its way through the supply chain, will be able to offer even lower costs than we're seeing today. Again, when you see commodity prices fall in the short term, that's a good forecast for what's going to happen 3 to 6 months down the road with all sorts of industrial and consumer goods. And so what about economic growth? Well, we keep revising up prior GDP numbers. So GDP gets revised up several times, and we can be halfway into the year before we know for sure what economic growth was a couple of quarters ago. So I like to show it, but we'll instead prefer to talk about the weekly economic index, which has a little bit of noise to it, but is amazingly accurate and highly correlated with the GDP numbers that we're eventually going to get. So we're here to talk about transitions. And I think one of the transitions that we can hope to see very soon is that not only have we not gone into a recession, but the rate of economic growth, while having slowed, may now have bottomed out. And we may start to see an accelerating economy. So, you can already turn on CNBC and watch regular guests coming on and apologizing for getting it wrong for so many quarters now, making their forecast that the US economy was about to fall apart. Well, as the economy begins to accelerate, that's going to be quite a bit of fun for us to watch. But I think, again, it's an artificial intelligence story. It's a capitalism story. The Fed has not been able to beat things back too badly. And if, in fact, the Fed is near the end of their tightening cycle, then I think it is not unreasonable to start to expect to see the rate of economic growth actually accelerate. And again, we're all investors here on this call. So if you're a stock market investor, that could be some really good news. And so one not quite the last recession comment, but I do like to show this probability that the Federal Reserve calculates every month. And I've blown these charts up a couple of times. You can go look them up yourself. Just go Google FRED, that's the Federal Reserve Economic Database, recession probability if you want to at any point in time get the current snapshot. But you can see in past recessions where we began to get a warning, some cases 3 or 4 months in advance before the recession officially started. Well, there's been a few warnings where we never got a recession, but it's kind of an amazing statistic. For all the debate out there, I'm not aware of anybody else that has made this statistic available to their analysis. But the last piece of data said that the chances of a recession anytime in the next few months is less than 1%, 0.62%. So if you're ever having a crisis of confidence yourself, just remember that you can Google FRED recession probability and see what this current measure is. And right now it's they're saying by their methodologies that it's virtually impossible that we're about to go into a recession. And you'll remember that I said, don't fight the Fed. Well, again, we spent 2 years fighting the Fed and hopefully justified that along the way. Now we can switch back to don't fight the Fed, because the Federal Reserve has a tool that for many, many decades was very important. And that is the ability to lower interest rates. They call it the Fed put. And a put is a type of option that if you own, you can make somebody else do something, right? In the financial markets, that's the way options work when you own them. And so the Fed put refers to the Fed's ability to lower interest rates, stimulate the economy, stimulate the stock market as well. The Federal Reserve is a bit concerned about the prices of financial securities, and they like it when the markets are healthy and everybody's having a good time being an investor. And so let's just say that we got an economic shock. We dodged the UPS strike. There's other labor issues out there, shipping companies going bankrupt, other things. But imagine a worst case scenario. Imagine a nuclear war in Ukraine or things like that. If there was some doubt to the ability of our economy to withstand that shock, the Fed now can lower rates. And they've said for years, we'd like to raise rates so that if there's a problem, we can lower rates again. So it's now a tool that they've barely had the opportunity to use over the last couple of decades because rates have been so low, certainly since the very near the beginning of the Great Recession. So now they're the highest that they've been in 22 years, I think it is. And so if something does begin to go wrong, if there's some other reason we have accounted for that we might start to slip into a recession, all they've got to do is lower rates. The markets actually think that they're going to lower rates, and you can tell because longer term rates are lower than short term rates. If we look at the blue line, that's right now, we see that 1-year rates are meaningfully higher than 2- and 3-year rates. And I think that's because the markets believe that inflation is going to continue to fall, so the Fed will be able to lower rates back down. But also, they're still going to be high enough if they settle out at about 4 or 4.25% that they can accommodate a lot of different shocks out there to ensure that any recession we might slip into would be brief. And so how has all this worked out for us? You'll recall my saying we've been talking about our investors not losing confidence in the markets for quite some time. You can look at the most recent 3 months, and there at the bottom is the global equity index, 5.89% for the last quarter, 13.25% year to date, over 16% in the last 1 year. And you know, we did have a dip. We did have a dip in 2022, but if you look at the 3-year number, the 5-year number, the 10-year number, you certainly can't see that showing up anywhere here. Now, you do see the effect of very low interest rates. The 10-year number for the U.S. fixed income index is only 1.52% per year, which is well below what inflation has averaged over that 10-year period. And I will mention to folks that as you see the fixed income performance of the index for the last 3 months at negative 0.84%. I think by and large, our clients did substantially better than that, because we are not investing to the index. We are investing a significant amount of your fixed income holdings in very safe treasury bonds that are earning a substantial rate and have almost no price movement. So, you know, a lot of folks on this call are going to see a meaningfully higher number when they look at their own quarterly portfolio reports that were recently released. So before we go forward, let's just take a quick review of the big 4 themes that we're talking about in 2023. The first one, stocks are a hedge in a changing world. Equity owners have always been the winners in the long run. We've certainly seen that with the numbers that I just showed. Fixed income is largely normalized. Inflation's falling, rates are up, so you can make some money in fixed income now, even after inflation. The third one there, we're not going to spend a lot of time on today, although my comments on AI are what has prompted this. You know, I'm still not sure whether the big winners in the stock market are going to be those few firms that are spending now tens of billions of dollars to compete to be your AI vendor, or if the real winners will be all of those companies that use AI. And you can think about past revolutions, the rise of the integrated circuit, the computer chip, if you will. And, you know, we know there were a few companies that were big winners for that, Intel, you know, among them. But look at every other company that uses computer technology. It's hard to find a company that doesn't these days. Those have been the real winners. Those have been where the economic growth has occurred. So with this new technology available, we're going to see companies that can't compete. We're going to see companies that can't adapt their strategy, can't keep up, and we'll see existing or new companies fully utilizing artificial intelligence to dramatically outcompete other companies. And I wouldn't be too confident that technology companies will be the big winner. We can all think of the past years when certain cell phone companies were the toast of the town, and you just had to have that cell phone, and then until times changed and they got crushed. So we're going to see the same thing with the artificial intelligence providers, and we're going to see it even more dramatically in users versus non-users of AI in every single segment of the economy. So this is not a time to own a lot in one stock. We've all got our favorites from time to time. I think maybe that's just human nature. But if you've got a lot in one stock, maybe it's got a very low cost basis, you're reluctant to do anything about it. Keep in mind that we have a concentrated stock strategy where we can cut half of the daily volatility out of that position with a certain specific way we use options. that can be highly beneficial and pretty tax efficient versus just selling the stock. So please reach out to us if you've got you think too much in one stock, and let's see what we can do for you. The fourth point here we're going to go into quite a bit in a few minutes, and that's talking about private market opportunities. We've talked already this year about how it could be a great time to buy because there's been a lot of disruptions in the venture capital world that have made it so that people with money can be very aggressive and pick up, we think, some fantastic deals going forward. We're fortunate that our clients have survived the stress of the venture capital markets extremely well and even profited from that already. But I'm especially excited about what those opportunities look like going forward from here. Okay, so quick review of what's been going on in the public markets, and then we'll slip into that last part. We're mixing up the agenda a little bit today. I think it's a little more exciting this way, but this is what's already water under the bridge, and we'll just move through it real fast. Let's just go to the timeline of events first. And again, we're talking about the second quarter of 2023. There was good news, there was bad news, and each one of these headlines are ones that we could probably spend 15 minutes on. I think the one that I'd like to call out, because we're nowhere near over with this, is this idea you'll see there in red. Banks fail due to rapidly rising interest rates. So I'm sure you caught the headlines a few months ago where a lot of banks had to raise the rate they were offering to pay their investors. But at the same time, they had locked in very low rates with those customer deposits. And so they were getting hammered by the Feds persistently raising interest rates to the point where some banks were beginning to fail. Well, I'm not sure that that is over with yet, but I'd like to suggest that failures in the commercial real estate segment, office space in particular, I think will continue to pressure a lot more banks. A lot of banks own real estate loans. And if we're talking about office spaces, those leases come up for renewal, you're going to see renegotiations at 10, 20, 30% drops to the current rate. Famously, Twitter is just not even paying its rent. So there's some of that as well. So you're going to see all sorts of pressure there. And so I'd look for more bank failures, more consolidations. I think there's well more than 10,000 banks in the U.S., and I wouldn't be surprised if in 5 years, that's cut by a half or more. So I don't think we're out of that yet. So that's worth mentioning. But, none of these headlines were enough to cause the market to not rise. We're actually off to a pretty good start here in Q3 as well. When we put up all of the arrows, it's almost all green arrows. We'll remind you that we're talking about various indexes here. And once again, the U.S. was the shining spot. I'm glad that we overweight the U.S. within our strategy here. We always show you the best and the worst in recent history to remind you of what real volatility looks like. So that little decline in the U.S. bond market index that we got in Q2 is really no big deal, especially because I think everyone here listening to this did meaningfully better than that. So for our purposes, we could, I think, say we had 6 green arrows pointing up. Within the U.S. stock market, you see a rally in large cap growth stocks. Well, you'll remember from last year, we were celebrating the rally in value stocks, not growth stocks. So what's going on here? Well, this rally sits on the back of a handful of stocks, just a handful of very large U.S. stocks. If you took those out of the mix, it might look more like a value rally. So it's just a few stocks that have driven that up. It's a bit of AI enthusiasm, let's say, but I'm not sure that those companies, as they rapidly increase spending, are going to be the long-term winners. I think it's all the companies, as we've said before, that use AI. Nevertheless, the U.S. is now up to 61% of the value of the global stock market, an absolutely amazing number to see. So again, I'm glad we overweight the U.S. in your stock market portfolios here at BIP Wealth. International developed market stocks, we'll look at that. Value did the best. The rest of the world continues to have a value rally, even if that handful of growth stocks in the U.S. have surged ahead. So outside the US and other developed markets, value is still the best place to be. International emerging market stock. Well, small caps did better than large caps. We overweight small cap even in emerging markets. Value did better than growth. So really, outside of the US, it's been a continuation of what was happening in 2022 in so much as value did better than growth. We've talked about REITs a little bit already, and we've cut our allocation to REITs significantly here at BIP Wealth. So I might not even include this slide going forward, except that it does give us the good talking point of what the heck is going on with commercial real estate. And most of what you have here as an investor with BIP Wealth is a broader exposure that includes warehouses and other segments that are in fact benefiting from the economic expansion. There is some exposure to office space, but again, we've just cut that way back. So I wouldn't be surprised if these indexes continue to lag, but don't worry. Again, that's kind of a token exposure at best for our investors. And then there's fixed income. It's always my favorite. You can just do a lot of math with fixed income. So always enjoy talking about that. But I've already shown you a curve, and that top line, that blue line, is where we finished the quarter off at on June 30th. And like we observed already, short-term rates are meaningfully higher than intermediate and longer-term rates. Now, a year ago, I was talking about the light blue line at the bottom. And a year ago, we said the Fed is behind the times. That, you know, the Fed is just always late to whatever it is they're doing, or they do it for too long. I think just timing is not their strength. So a year ago, we said, look how low short-term rates are. Inflation is running away in this economy. They need to raise rates sooner. And the market knew they would, because you go out to just a little bit farther in time, 1 year, 2 years, and rates were meaningfully higher. Well, it's the opposite now. The market says the Feds are going to have to lower rates. They're way too high. So when you see this kind of dislocation in the curve, it's really just telling you that the Fed is not quite listening to the market. They're late, they're early. They've got their timing off, and the market already knows what they're going to do in the coming months. And in this case, what it says about the Fed is that they're going to lower interest rates. Maybe this year, or maybe it's the beginning of next year, but the short-term rates will need to be lower. And so, you know, what does all of this mean? Well, you know, what's interesting is that the new opportunity we're talking about here isn't directly related to what we've talked about so far. We've talked about all the transitions. I want folks to stay invested in the stock market. If you've got new cash, it's a great time to go into the stock market. But there's a specific type of new opportunity that I want to talk about. And it does get into what's going on in the public stock market. And it does get into that idea that just a few stocks in the biggest companies are sort of wagging the tail of the market, even if you index and try to get diversified. But let's go into a comparison between public markets and private markets. And I want to give you what I think is some very interesting data. Now, I'll start with this notion that is incorrect, which says that private markets is just a collection of little mom and pop startups and small companies that, if you want to be invested in meaningful companies that are the biggest part of our economy, you need to get that through your investment in the public stock market. And I think some of that view has come about from the idea that it's easy to invest in the public stock market. You might not do it perfectly, but it's easy to invest. And, you know, perhaps the easiest way to invest is just to buy a stock market index. So think for a minute about not those little companies, but all the companies in the United States that have at least $100 million in revenue. Those aren't small companies. $100 million in revenue is a pretty big number to start with. And, you know, if we look at the pie chart on the left, and we look at these companies that have $100 to $500 million in revenue, that's the dark blue. On the left, with private companies, that's over 11,500 companies. If you look on the right side, if you buy this, not the S&P 500 index, but an all U.S. stock market index, how many companies do you get? You get 823 versus 11,507. So certainly for those companies, 100 million to 500 million, the public stock market index is not diversified. You're missing a substantial number of the companies that are out there and all the innovation, entrepreneurialism, and growth opportunities that they offer. But let's go bigger. Let's go to the next tier up. 500 million to $1 billion in revenue. We've got those wedges of the pie here depicted in orange. Well, if you buy that stock market index in the US, that's 412 companies, but there's 1,755 private companies. It's only when you get to the biggest companies that it gets even close, companies with $1 billion or more in revenue, and there's just not that many of those. In the stock market index, you've got 1,321. In fact, when you buy the US stock market index, mostly you're buying large companies. Well, that's 2,127 in the private markets on the other side. So it's almost half as many. But, I asked this question at the top of the slide. As of June 30th, the top 10 stocks in the United States total how much of the total dollars, if you value all the shares of stock out there? Well, those top 10 stocks in the US are 26% of that stock market index. In just 10 stocks, 26% are in just 10. So, even if you wanted to argue that the public market was sufficiently diversified because of the number of companies, 3,000 plus companies, you're still mostly invested in those big ones. Now, it's funny, globally, the top 10 stocks globally, now we're talking about 10,000 plus stocks. Well, if you buy the global stock market index to get exposure to that, 15% of your money is still in 10 top stocks, and they're all big US tech companies. So, when that part of the market pulls back, a lot of indexes are going to get hurt. But a value tilt and a concentration in smaller companies helps. What helps most of all is to own a lot of private companies, and that's historically been difficult to do for a variety of reasons. It's not like you can just go put money in all of these companies, but there's some new legal structures that exist out there and some innovation that is going to make it a lot easier to do than it was in the past. Let's go to the next slide here. And let's talk about, other than diversification, why would you even bother to invest in private markets? Because, diversification is a pretty good reason. And we hit that pretty hard in the last slide, but why else? Especially when, and this is the question that every investor in private markets is asked at some point. When do I get some liquidity from my private market investments? And the old answer was when the general partner, that's who's running the private market investment round, says you get liquidity, right? You invest in a private market security, and maybe you're expecting you're going to get liquidity. There will be a sale in 3 years, and a decade later, you still don't have any liquidity. Well, that illiquidity actually is the reason we think that private market investments as a group have offered higher returns than the public market, and sometimes meaningfully higher. One of the most fun things that I ever get to do is host an event, especially when we do some nighttime events, and our customers or our clients are getting to meet other clients that they've not known. They're sitting at the same table and having a glass of wine. And I always love those events. And inevitably, I hear about a conversation where a newer client that is thinking about doing some private market investments is talking to a longtime client who has done a lot of private market investing. And you hear them begin to talk about the kinds of returns that they've received. And sometimes you'll just see the eyes go wide, the jaw drop for that new client as they hear about that person's particular experience. And so, again, the illiquidity premium, we think, has been the driver of higher returns. And there's different data sets out there that would attempt to describe that. I'll say right now, most of our private fixed income investors are getting yields that are into the double digits. And that was especially important in 2022 when the public fixed income index was down 13%. So, it was very common to see private fixed income beating public fixed income, by 25% or more. So, and of course, on the equity side, that story's been out there a lot longer than that. And so, I'm excited to be able to say that maybe the new answer to that question, when can I get some liquidity from my private market investments? Maybe that new answer is going to be, well, when would you like liquidity? What I'm talking about, many of you know this already, what I'm talking about is a new legal structure that we're calling a BDC, stands for Business Development Company. It's actually a bit of a broader category than you might think. There's multiple types of those out there, but it's a different legal structure from the one that our longtime clients would be familiar with, where we round up a group of investors. There's a general partner, you're the limited partner, you put your money in and you just don't know when you're going to get liquidity. It's not up to you to determine, unless there's a tender offer, and those are rare. It's going to be when the general partner is able to sell something in that fund, or to sell that specific company that the funds were invested in. Under the new structures, what we're expecting to see is that after a few years, you can request liquidity annually. And so I just got to tell you, I think this is an absolute game changer for investments. If you can get liquidity when you need it, but still enjoy the illiquidity premium that, finance and economics analysts like myself think may be the reason for the higher return. It is a bit like having your cake and eating it too. And, I think our average client maybe has about 1/3 of their money in private market investments and about 2/3 of their money in public market investments. I personally won't be shocked if 5 years from now that is flipped, and the average client may have 2/3 of their money in private market investments and only 1/3 in the public, enjoying the higher returns that those markets promise, and still having liquidity when needed. And liquidity is super important. I don't want to minimize the need to have a really thorough analysis of that. Back in the Great Recession, even some of the biggest university endowments like Harvard were having to meet capital calls for their private market investments at a time when the public markets were at historic lows, and they were having to sell off. And so, that's one reason we do financial plans for our clients, is we want to make sure if you're going to get into illiquid investments that you can tolerate that. But if we can get this liquidity, then I do think that is a game changer. And, one other feature of this new structure, and again, we call it a BDC, our sister company, BIP Ventures, has branded their new private equity BDC as an Evergreen Fund, because it never goes away. It'll be out there forever. When you want to put money in, you put money in. And there's no capital calls after that. So you can decide, and we don't have a limit on the number of clients that can get in. And often that's been a big limiting factor, and folks couldn't get into investments they wanted to get into. So, I could just go on for hours about the virtues of this, but BIP Ventures is actually hosting webinars. I would encourage you to attend one of those. There's still more on the calendar. They've got started, but there's more coming. And I think this really just may become the new way that many of our clients are choosing to invest in the private markets. And it offers the hope of being even more diversified than ever before within private equities and within private fixed income, probably by the end of this year as well. So it just kind of changes everything. And so we're just super excited about this and just can't wait to be able to talk to individual clients about what this could mean for them. So let's talk about our toolbox, if you will. Our toolbox is more full than most advisors can brag about. There's the cash and fixed income and public equity. That's sort of the core that is all many investors will ever invest in. Historically, it's kind of everybody could do that. You could do it yourself, maybe not as well as professionals, but it's sort of the easy way to invest. But we can add in hedged yield, which is synthetic fixed income. It's certainly, if you've had that one of those accounts, beat the public market fixed income index in a pretty healthy way. There's our hedged equity, which is a way of investing in global equities, but taking the edge off of the volatility, which can be a great thing in volatile times. You see the private fixed income, you see the private equity. And, when I program our financial planning system, this is roughly the order that I put things in from lower risk to higher risk, even though what our clients have experienced doesn't quite match up with that. Some of these things have worked so well that it would be easy to perceive these as having far less risk than what I'm describing here. But I put in a higher level of risk for some of this stuff, just based on what the industry does, as opposed to what we've necessarily offered. The big challenge for me is that I can't put in expected returns that are nearly as high as whatever clients have enjoyed. It would just cause people to scratch their heads and go, can you really make that much money again? And when we're showing this to clients that have had the experience, they might notice that we're being conservative by showing higher risk, we're being conservative by showing lower expected returns, and it still makes sense to do all these things. If we don't have liquidity as such a concern for the future, again, I expect to see a lot more folks piling into the private fixed income and private equity. But on top of that, we've got two newer strategies that I'm still showing at the top of the toolbox. We've got to figure out a place to slide them in. The first is BIP short-term tactical. And so, we're pretty confident that we can earn you returns meaningfully higher that you can get at any bank account. And we can do it by exposing you to the treasury market, where you really don't have to worry about FDIC limits. So we have a version of that for individual companies in the VC market, but we have a version of that for investors as well. And so you can get immediate liquidity, have the safety of investing in treasuries, and enjoy yields that are higher than any FDIC insured bank account that I've heard of. And then we have the BIP concentrated stock strategy that I mentioned earlier as well. If you've got a lot in one stock, and maybe it's been doing great, and God bless you, there's a lot of them out there that have big tech names in particular, but if they come under pressure in this new dynamic environment, if you want to protect some of those gains and you don't want the big tax hit, please talk to us about what we can do for you if you've got a lot in just one stock that you're reluctant to sell. So when we look at this big toolkit now, it could mean a lot to our investors, and it could mean some changes in strategy. So, let's just go ahead and wrap things up with some final thoughts here, and I'll end by coming back to that. The first is, this is a year of transitions. Don't worry about what you're hearing in the news if you hear a lot about things have changed. Remember our key themes, and remember in particular that there's a new way to invest in private markets. These new tools in the toolbox might mean for you the following. You're meeting with your personal wealth advisor. They say, hey, I've got a lot of changes that I want to propose. We've got some new tools that we can employ. If you've got an account where money is coming in and money is coming out on a regular basis, maybe it's to fund your private market investments, maybe it's to receive their distributions, maybe it's because you've just got a dynamic financial life, maybe that short-term tactical account is perfect for you. Maybe you've never done hedged yield, but you kind of like some synthetic fixed income that has historically had some pretty good performance, or maybe it's these new ways of investing in the private markets. It's more complexity. There's going to be some paperwork. It might be more statements from your custodians. It might be that your quarterly portfolio report goes from being 35 pages to 45 pages. It does seem to bring with it a little bit more complexity. But at the end of the day, it comes down to this. In this business, for the advisors at BIP Wealth, for myself, what we want more than anything for you with your investments is to be able to bring you a higher return and lower risk. And the reason that these new tools exist is we think those are the tools that can allow us to do that. So we're always driving towards higher return and even less risk. And we just hope that all of you that are listening will have an open mind to the changes that your personal wealth advisor might be proposing, because it could be a lot of changes. And but we think we're proud to be able to offer that, and we think it's going to be of great benefit to you.